All right, good morning, everybody. We finally made it to FOMC. The base case argument is that we will go sideways into the event, and then there's usually 4 legs in the event. So at 2 o'clock, we get the data dump. At 2:30, we get Powell. He comes out with prepared remarks. He finishes those remarks, and then he starts taking questions, and then he wraps it up, and we get the last leg of the move, uh, the market digesting everything that happened. So just try to keep that timeline in mind when we get the first initial move at 2 o'clock. There's been history where the first move is the move. We don't see anything going counter to that, and it just drives and drives in one direction. It's very likely not going to be today. Then there's times where we get the first initial move, and then he comes out with remarks and it counters that move. Then he starts taking questions and it goes in another direction. So just tread softly, I guess is a good way to put it. There's a lot of traders that I know who do not trade FOMC weeks. A lot of traders that I know who don't trade on contract change weeks. I still am hearing from people who have their charts all screwed up and it's still showing this big gap up from where we were on Friday to where we were on Monday with almost a 100-point gap between the December contracts and the March contracts. And their charts are just still showing this big 100-point gap. If you're on paper, it doesn't matter, right? You're not going to hurt anything. But if you're using an eval account or, using your own money and your charts are still screwed up, probably don't want to be putting real money on the line, right? Don't want to actually be risking anything. Small caps are up the most. Hong Kong is down the most at only 0.25%. Everything else chopping sideways, waiting on data. It's exactly what we anticipate for today. Since it's Wednesday, we should be getting crude oil inventories. We're going to get some housing data. None of that is expected to be out of line. The inventories can always miss. So, it should be in line, but this is one of those that can sneak up on you because it's data we get every Wednesday. Most of the time, there's nothing wrong with the data. It's the same old, same old, same old, same old. Just every once in a while, they'll slip a number in there. It really moves the market, and then everybody says, "Oh my gosh, what was that? Wow, where'd that big move come from?" The 1030 oil report. Believe it or not, energy still has impact. So there won't be a lot to today's briefing because there's not a lot that we have to do other than just hold the line and wait on data. The Fed's decision on whether or not to cut is pretty much baked in. That's nearly a foregone conclusion at this point because they don't want to surprise the markets, right? They don't want to play gotcha and try to trick us and then, you know, shock the market and get big moves. So they've telegraphed that they're going to cut. Yay. The question is on forward guidance, how many cuts are we going to get next year? The dot plot says a full percentage point, so like 4 quarter point cuts. Money markets are pricing in 1/4 point cut. So there's a little bit of a difference there. We're going to be listening today for statements from the Fed about easing and slowing. They started doing interviews and articles. I shouldn't say started to. They already had them in the works because they go into a blackout period, where they can't do that. So we're getting the whispers and the rumors and the hints, because that's the kind of messaging that they use, that they want to stop cutting and try to hold at an elevated rate for a while, because they don't know where neutral is. It's not their fault. Nobody knows where neutral is, right? They just have this hypothetical idea of where neutral is. It's an imaginary line, and the line moves. So it makes it a little tricky. This morning, we're close to the upper ADR, the round number 6150. It's an options level. It's a key level. You always want to pay attention to 50 and 100 levels. We're really close to it, so it's likely that we go ahead and gravitate to it. That was the base case argument this morning. And we started moving in that direction, and then we stalled out again. Now, with data on the table, we could get, a violent move and just go up there and wick it. But I was more interested in actually grinding up there and getting to it. Doesn't seem like we're going to get that now. We're sort of running out of time, but we have an hour at least until the next event. So maybe in the next hour, we'll just go on up there and get it done. Since we're close enough to it, it'll act a bit like a magnet. Otherwise, if they front run it, dump it back down on us, then we just hold the line. The ADR now is below 80, so it's getting more and more narrow. You can see that the daily expected move is at 46 and the average daily range is at 47. So we're in line with what is expected out of the market. The one standard daily deviation is at 55, so it's a little higher out. Still not out of line. And we have to discount the market maker move. Can't use it. Don't want to just ignore it. Pretend it doesn't exist. So we've been setting these lower highs, but we've been setting these equal lows, and we're starting to develop a bit of a wedge pattern. It's still a topping pattern. It's not quite a complex topping pattern. It's just a topping pattern. Unless or until we break that low and start building out new lows, then we don't have a short. It's more preference than anything else, but I'd rather short from the highs than short from the lows. Simply from an LRE point of view, right? Low risk entry, you risk less money shorting from up here than you do trying to short from down here. But if it doesn't go back up there and let you get short from the highs, or there's no signal to short from those highs, maybe it just doesn't feel good, whatever. Let it reverse off of those highs and at least begin working its way back down so that you can short on the way down rather than trying to short as it breaks that low into new lows. But we're on hurry up and wait mode anyways with FOMC today. Take what we're working on now and just bring it back over here, right? Same kind of logic, same sort of concept. Or same thing if you want to flip the chart over from back here, right? So it needs to do something if we're going to get it. If you try the argument in the range, you don't have a solution yet. Are we done with this? You don't know if we're going to break out or not. So little bites, I guess, is the concept. Looking at it on the daily, you can see the 10 and the 20 sort of flattening out. They're not tangled yet. They're not crossed yet. The 10 is still above the 20 for now. But because of this pause that we've been in, it's given everything time, like back here, where they were running parallel, a bit like railroad tracks, equidistant. Price was holding above all of it, finally broke down through it, then chopped sideways. And it was that chopping sideways that gave the moving averages time to stabilize, so that if we break down now, that 10 is going to cut down really fast, like it did back here. It won't take as much time as, say, when we cut through it here, and the 10 was still drifting up, and it had to kind of like throwing a ball in the air. It has to reach its peak before it can start to fall. That's kind of what was happening with the 10 there. But we don't have that problem. We've been running this sideways stance. So a quick dip below that 20, I think it's very easy we go to 50, just like we did back here. Surprisingly enough, though, that wouldn't be bearish. I know that may sound counterintuitive, but a good, clean, solid, healthy pullback to the 50, there's nothing wrong with that. It's a good thing. Today's central pivot is lower than yesterday's. That's bearish. Price opened underneath it. That's also bearish. The channel is about as wide as yesterday, visually speaking. They don't seem to be that different. A really wide channel implies that even if we do break out, the breakout doesn't stick. This isn't as wide as this example back here, right? If we look at today and we look at this one, well, that one's obviously wider, bigger. But these channels can be so narrow that all you see is the purple line. You don't even see the yellow lines or the shaded area. That's how skinny it could be. And the more narrow or the more skinny the channel, the more likely it is that a breakout sticks. Just keep in mind that these channels don't make price breakout. They don't make price fail on a breakout and come back in. They just give us insight on what to expect if we actually did get a breakout. I wouldn't put a lot of weight into them either on event days like non-farm payrolls and FOMC. Because of the ADR being so skinny, we have to be worried about very narrow pivot points. So here's the high of this day and the low of this day. This is the S3 and the R3. And from price, you can see it was a long ways away. If we look at where we opened last night and how far we have to go, it's not very far, right? These are much more compressed than they were, say, last Thursday. The distance to R3 is much shorter. On the one hand, that's cool because we can get to the S3 or the R3 easier. But on the other hand, it's an event day. So the idea that we would get the kind of volatility that would push us to that level and beyond is very likely. I bring this up because I know a lot of traders who have zero-day tactics, which employ things like the S2, S3, R2, R3, and selling credit spreads if price has moved, X distance by noon or whatever. You'll want to be careful on a day like this about selling spreads. Nothing wrong with doing it in the morning, and then closing it by noon, opening up your other one in the afternoon, and just not opening one for the afternoon because of FOMC. I would stress caution on that. Today's 0-day credit spreads from the morning till noon may not decay the way you would expect them to because of the afternoon event. If you've done it before and you understand what the impact is, don't let me stand in the way. But if you're just contemplating that for the first time and thinking, why not? If we're going to go sideways into FOMC, maybe I'll sell something. Proceed with caution. It wouldn't hurt to consider some outliers, though. Lottery tickets, when you go to the gas station and you spend $1 and you get a scratch lotto, so what? It's $1, right? You pay more taxes on your coffee than $1. Who cares? It's a buck. You don't want to get a $200 lottery ticket because now that's not a lottery ticket, right? That's a trip to Vegas. Go to Vegas, at least you get free drinks. But if things get lit today, Powell says something that really sparks the market, getting to a round number like 6,200 is not off the table. So if you can buy SPY, SPX, ES, and you can buy them cheap, like a cheap call, or even a cheap put at 6,000. I know that might seem like a long ways off, but that's what a lottery ticket is for, right? Maybe even 61, but I don't think you would find anything cheap at 61. I mean, that's just, I think it's too close. Swap it over to something like SPY, maybe just clean up the noise here a little bit. 15, that would probably be cheap, or 600, maybe 595. Just go in there and look at what's cheap. Figure out how much you want to spend and buy something that far out of the money for today. These numbers aren't going to be accurate because it's pre-market and we don't trust the options prices that we see in the pre-market. But for an example, if we come out here and we see $3, right? Maybe split the difference, work the order, get this for $2, and now you've got a $613 strike on SPY. Not necessarily because you think it's going to go to 613, but because you're buying a lottery ticket and you don't want to spend more than $2, right? That sort of thing. Or if you did it in a spread, maybe find something a little better than that, but you can get a spread cheap to where you're risking $2, maybe $3. Not a big deal. That's what a lottery ticket was for. And you can do both sides, right? You could do a put, do a call, then you got it covered. If we go down, we go up. Just keep in mind, these really far out of the money options on a 0-day like this, they're almost guaranteed to lose. Just like going to the gas station and buying a lottery ticket. Do you really think you're going to win $1 million every time you do that? No. You're lucky if you get a $2 back on your $1 lottery ticket. So these really far out of the money options are cheap because your chances of winning are really low. Just like the lottery is really cheap because your chances of winning are really low. If your chances of winning are higher, so is the cost of admission. The options price itself will tell you your chances of making money. Or you can use something like delta, which is a version of probability. What you don't want to trade are all of these with the exact same number. Just avoid those. That's bag holders. It's trash. There's nothing here. You can see all these people that are trapped. They want out, and they're just begging you to buy their contract so they can get something out of it. So avoid the bag holders, avoid the trash. Same thing in the other direction. These numbers are supposed to continue to go down. So if you see them going down and then they start going back up again, or they got matching numbers on each side, this is trash. Just leave it alone. You could also consider lottery tickets for the end of the week. If Powell moves the markets today, it's likely that the move will stick through the week. So you could consider, getting something for Thursday or for Friday. You might have a better metric, right? Better price, especially if you're doing something like a butterfly or, maybe a gamma condor or even just your regular iron condor if you want to go that route. And while we're on it, SPX is going to allow you to get farther out of the money. So if you're going for those wild, wild outlier events, like really far out there, use the SPX. Don't use this AM settled contract. Just avoid that thing. Always and always, right? Just never trade that. You're good. Leave it alone. Through our own volume profile here, we've got a high volume node above that 6150. So I'm a little surprised that they're front running it this morning at 6146 and holding us back. My intention or idea was that we would get into 6150 and actually overshoot it because liquidity resides on the other side of the pivot, and then we'd get tangled above 6150. Surprise, they got us on the bottom of it. Throughout the day today, though, if we do hold above 6150, I'd be expecting that point of control to move up. 6132 cog line, if we're going to stay above it, won't be able to keep that point of control. As you can see, if we break our own low and cut that 6100, which is really close to the 92 cog line and this point of control from back here, then we've got a deep air pocket down to 6,000. It's an easy 6, right? I mean, what's 150 points among friends? So volume's fine, sitting in the 50s. It's actually a bit of a surprise to have that elevated volume at this point. You see, we've been dancing back and forth through the 10-week. This is, or excuse me, the 10-day. This is the 10. So like a magnet, we got around it, and we've been chopping around it ever since, like a pendulum on a clock, back and forth. But every time we've been sweeping back up, the sweeps up have been getting shorter and shorter. They've been doing really good on the downside, defending this low. How many more times they're going to defend it? Your guess is as good as mine. All right, this is starting to turn into one big classic D-shape profile with the point of control in the upper section of this thing. Throughout the week, as we continue to shift into next week, we should expect that point of control to move down into the new level 61.55 or 61.60. It's really dependent on how much of that volume is from that level right there. If we look at it on the TPO, it's very likely that's going to be the new profile location. It really just depends on how the rest of this week goes and how much of this high volume node is from that volume right there. Otherwise, 61.25 would be the argument, or 61.32 into next week. And if we're above it, that'll be our springboard for the rest of the year and that ramp to the upside that we've been looking for. No new VPOC from yesterday. If we had put one on, we would have ran it over last night. The textbooks will tell you to put one on anyways. On a day like this, if you're looking for any edge at all, maybe it wouldn't hurt to have it on there. I've got enough pivot points. I don't need another one. So I'm not going to carry it forward because it's not a VPOC. I thought maybe it was also yesterday's regular session open, but it wasn't. Didn't hurt to look. So I'm not going to carry it forward. I don't need it. We still have one from yesterday. And all the old ones from the other contract, we've already taken them off. Not going to carry them anymore. So 61.54, if we overshoot the 61.50, I'd expect some liquidity at that level. That'd be Monday's point of control. For today, at least this morning, we're developing a P-shape pattern. Right, really skinny. But if we continue to hold out this level, then we're actually developing a second D up here with the point of control in the lower D. These two yellow lines represent this week's range, since the indicator is obviously not functioning correctly with the new contract change. So we went and measured it all out yesterday. 62.11 to the upside, call it 60.40 on the downside. That's the week's range. There's a 70% chance that we close inside that range. If you're thinking about butterflies, you know, that's not a bad way to go. Just building one on the edge. SPY doesn't have the contract change issues, so its weekly expected move is in line. Thinkorswim is froze, so gotta give it a second. Come on, you can do it. There it goes. A butterfly at 611 or 596. See, the problem with butterflies and these weekly expected moves is that there's not a strike for 596.5, probably. So you go in and you try to put a butterfly there, you'll have to be above it a little bit, or you'll have to be below it a little bit, or just make it wide enough where it covers the whole thing. Same thing to the upside. This line isn't on 612 and it's not exactly on 611. So then you have to try to choose, well, which one of those do I really want? For me, I'd rather go towards the closest round number. So 611.86 is closer to 612. But if it was 611.25, well, then I'd just drop down to 611, right? It'd be the closest round number. You could put one right where we're at. You know, that's Friday's close and yesterday's close, 604, on the idea that we actually doji on the whole week, right? That we close the week right there where we're at. All right, these are FOMC lines in pink. And maybe it's easier to see if we turn off the contract to change events. And if it would have stayed dark, I think we just ran in a circle. All right. So after FOMC, this would be the FOMC day. It ends up in the middle. It's just the way that it is. You see how the next day after the FOMC, we ripped up, and I believe the September one was the one that we had on a Thursday, right? So it wasn't a Wednesday like normal. This kind of helps put it into context of what day of the week it was. Just put the weekly expected move on it. So it was on a Thursday, no, on a Wednesday on this one. Thursday got us to the edge of the weekly expected move, and then on Friday we just stayed around that level, right? We closed near it. Would it have been, near enough for a butterfly? Maybe if you'd have built it wide enough, but I'd argue no, probably not. There's another one with FOMC on the Wednesday where we ripped on that Wednesday up into the highs, and then we spent 2 days just doji, doing nothing, but we did close outside of the weekly expected move too. So if you want to, have tradable setups for FOMC, go back to the previous FOMC days and look how the week ended, look how the day ended. Places like Edgeful, they've got statistical data on different economic events like non-farm payrolls, FOMC, that sort of thing. So you can get some insight from that too. It doesn't just have to be for futures traders, right? Or even just for options traders. You can use the same thing and do it on equities, Apple, Microsoft, whatever. Take that route. You can find previous FOMC days for years, right? Just hit Google, ask it for the previous FOMC day events. The more data you can add to it, the better. Like when you go to a previous FOMC, what was that decision? Did they hold the line? Did they start cutting when they hadn't been? Were they continuing to cut? Were they continuing to raise? Was it an emergency session? Because we've had those over the years where they just have an emergency FOMC meeting and they cut. So the more data you could put together so that when you look at the chart on those weeks where we had FOMC, the better you can plan for what we could get from this FOMC. That same tactic, by the way, works for non-farm payrolls. Anything else they want to do, CPI, PPI. If you're going to plan for it, look what it did before. So getting a bit of a fade now in the VIX. Remember, FOMC is volatility suppressing. So as we go through the day today, it might start to drop a little bit more. And then we're going to get the event, a lot of volatility, and then they'll take it off the board, right? Bitcoin also a bit of a fade. China down, bonds down. I was looking at some volume yesterday, well, this morning, for yesterday's volume. That HYG had 589,000. I just rounded everything. This is options contracts on HYG. 589,000 contracts traded, which is, I mean, it's pretty good. It's 3 times as much, well, 2.5 times as much as Intel, for an example. You know, that's more than Meta had at 232,000. So bonds are getting flows. So this morning we got banks, we got the Mag 7 and semiconductors. I got to tell you, those 3 are completely risk on. They're what we would look at if we're looking for a rally day. Yeah, it's a customized study, but really it just draws a line, right? Like I wrote the code and I have to tell it draw a line here, draw a line there, right? It doesn't go read data and put a line in. I just had to Google the date, put the date in there, give it a tag, and then hit enter so that it just draws the line where I told it to. I wish it was a smart one, right? That it could go and read the data like they have on TradingView. TradingView can go fetch the data and then draw the line in the appropriate spot. That would be awesome. I have to go get the data and tell it, yeah, draw a line here. So not as good, but for visuals, like just doing this little back test, it works good and good enough. You can also just draw the line, right? You could just manually draw a line, which I had done for years this way. But you know what happens? You forget that you're on your drawing set, and then you go into the intraday and you draw something, and then you tell it to delete all drawings, and you accidentally wipe out, 3 hours of drawings that you spent putting in all those CPI, non-farm payroll data events, and you have to start over again. So I got tired of having to redraw my lines and decided to just make an indicator to draw the lines. Plus, then I can stick it on different names like Apple, Microsoft, SPY, the Qs, whatever, and I don't have to draw the lines on every one of those. Yeah, you can do it. I can give it to you, right? I don't sell indicators. I just give them away. So if you want it, I'll share it. It's not a big deal. If you ask ChatGPT, it'll show you how to do it, right? There's no magic to it. It's very simple. So the 3 sectors that we want for a rally day are financials, technology, consumer discretionary. Now you can broaden that out into things like, quote, technology, to say we want the semiconductor sector or we want the communications sector. So, we can be a little more specific and not so generic when we say technology or consumer discretionary. But broadly speaking, those are the risk on sectors. You don't want a rally day based on staples, healthcare, and utilities. That's not the kind of market we're looking for. And that's what we have in the pre-market is semiconductors, communications, consumer discretionary, the Mag 7, It's a good thing. It's already leaning towards a breakout to the upside and a rally day. Just keep in mind, if we do break out and start to rally before FOMC, approach with caution. So that's the best I got. I wouldn't trust it, but we've seen it before, right? Where it breaks out and it runs, and then we get data, not necessarily FOMC, but we get data and it continues to run and it just keeps running the whole day. And nobody trusts it. And so, we miss out on it and then it just sucks. So grab a cheap lotto first thing this morning, let it ride, right? Because these are the sectors that we want to see if we're going to have a rally day that sticks, not just a rug pull where they dump it on our head 30 minutes after the open. Semiconductors being up, I would say watch IGV or IGM, the software ETF. There's been this struggle between software and chips, and we haven't really had the money flow for both. And we do. We've got IGM there and SMH here. If we get both of those today, we could really rip to the upside. I mean, that's exactly what we need. We need, get NVIDIA up and running, and it had already started that reversal off that 128. Look at that big gap up. It's trying to come back around. So you get NVIDIA, ARM, Intel, MU, MSTR. You get some software names coming in with it, and then Bitcoin. Oh, this thing could shock and awe, surprise everybody, and just rip to the upside when no one's looking. Yeah, I think that's absolutely on the table. Especially with this flattening wedge that we've got here on the daily, right? So we've got the sectors, we've got the low volume. All we need is a little bit of spark, and this thing can get it. There's always a question about how far could we go. One little tactic to that on an intraday basis is keep your eye on the change percent. They like to hit round numbers, right? 0.5%, 1%, 1.5. Sometimes the quarters come in, so 1.25, 1.5. You can Google the last time we made, say, a 2% move intraday. Ask that question on the SPX or the SPY. Don't use the ES. It'll make it easier for your search. So if we're going to get one of those kind of days, we want an inside week breakout as a part of the target. And that's going to be a little weird because if you hit weekly, then it still shows that we have that gap up, right? The continuous contracts are still goofy for at least a week. Brokers are going to have this issue. So if you go to the weekly, it's all jacked up. It shows that we're not even in the weekly range. Stay on the daily and just count back to last week. Mark last week's high, last week's low, and then look for that inside week breakout. So what I got for you guys, watch the clock, be careful, be safe, keep your eye on the news. One little spark could send this thing off when we have these sectors up in the pre-market. I'll see y'all tomorrow.